Welcome to the broadcast. My name is John Mayfield, the real estate tech guy, and thank you so much for joining. We're going to wait just a couple of quick moments to make sure the video stream stays intact. So I use a program called Switcher Studio. It's a great program. I really love it. It allows you to live stream through Facebook and Instagram, but unfortunately, a few weeks ago, the YouTube connection was not working properly, and they had sent a message out saying they were trying to fix it. So you could still stream through Switcher Studio, but I was having some trouble with the live feed dropping, but it looks like we are moving good. So we're going to get right into the broadcast tonight. I know the last few weeks, sometimes I'm just going to go ahead and say it. I ramble, but I don't mean to ramble. I'm showing you things you need to know for the real estate exam, and I'm trying to go over some essential information for you. But we're going to get right into the session tonight. I just want to go over a few quick things as your instructor, and then we'll jump over, and we're going to actually go over to the whiteboard tonight. It's a little bit of reflection, but I think things will work out, and I believe it'll work pretty well for us tonight. A couple of quick things. Do not forget that you have the candidate handbook in your course dashboard. You need to download that handbook and look at that. So whichever state you are in, whether it's Oklahoma, Indiana, Missouri, Kansas, or South Dakota, the appropriate handbook for your state is in the dashboard. So I encourage you to download that, look at it. That gives you all the information you need to know to set up your examination. Now keep in mind, you cannot set up your examination until after you have completed your pre-licensed real estate school studies, okay? And in fact, they warn you that, have you completed the school? So do not set up your exam until you finish the course. So if you're in Missouri, when you finish the 48-hour course, you can then set up your test. Kansas, same way. You finish the 30-hour course, you can set up your examination. And I encourage you to do that just as soon as possible. There might be some places throughout the course where I say, hey, if you want to just take part of the exam and go back and take the other part, but I really think some of the best students' pass rates are the students who are going in taking both parts just as soon as they can after they finish the course. So just want to remind you to do that. Be sure you set that up. I'm getting really close on this brand new study program. It's called My Real Estate Exam Coach. I hope, and I'll probably be putting some of that in your dashboard. So it will be under the practice exams, but I'm going to change the name of that. So if you go into your course library and you see this thing called My Real Estate Exam Coach, that's where the practice exams are, but that's where also this new product that I'm working on will be. I'm going to give it to you all right now free. In the future, I'll probably be pulling that out for Global Real Estate School students, but they can still purchase it at a substantial discount. But for those of you right now, it will be included for you at no cost. You might get in there. There will be some sections that do not have audio, maybe does not have a video. I'll be updating that as we go on. But the really cool thing is it's broken out by the topics for the examination. So you'll kind of see now if you go into the practice exams, I still have the big module for practice exams there, but underneath that are all of the practice questions, but they're broken out by subject matter. And I did that for a couple of reasons. Sometimes if someone doesn't pass the examination, they may not do well in a specific area. Well, this way you can go study those specific topics and you'll be in good shape. So just keep an eye open for that. So looks like we are broadcasting loud and clear. I'm going to move us over to the whiteboard, and we are going to get started on some math problems here. So I hope you are having a great evening, and thanks again for joining. I am hopefully on screen here with you now, and hopefully you can hear me okay too. I think we are, because it's showing the volume level seems to be going okay. So I'm working on the lighting, but I think things will be fine for us tonight, and we'll go through some math problems here this evening. And my little dog Lucy's down here with me, so if you hear a grunt or a groan or some snoring in the background, she wanted to hang out with me down here in the studio, so she's down here watching from over on this side. Well, a couple of the things we need to know for the examination are how to solve commissions, and so and loan to value ratios. So we're going to work a couple of those. The first question I have here, and I'll read these to you, so I'll kind of go over these a couple of times, but and I may have worked this specific question for us on our last session, but broker Bob sold a home for $350,000. If he charged a 7% commission, how much commission did broker Bob earn? So again, the broker sells a property for $350,000, charges 7%. What's the commission rate? Now, and I know we may have some new folks on the class, and I want to say thank you, because we've really just been getting a lot of students that have been signing up, and it's amazing, and so I want to thank you. Do not panic if we go over something and you haven't covered it yet. That's why we're going over this tonight. And I will jump online. If you have any questions, you can type those in, and we'll be sure and take a look at those for you. But one of the things we talk about with our math formula is this T problem. And I was taught this years ago when I went to school, and I started teaching it when I started my real estate school back in the late 1980s. And it's called a T formula. And basically you have P, which stands for part, and you have T down here, which stands for total, and we have the percentage, or sometimes referred to as the rate. Now, there's a couple of interesting things about the T formula that I want to point out. Notice I put some mathematical symbols here. That's not going to work, so we'll get rid of that. We have a multiplication sign down here, and we have division. Now, on your exam, I always encourage you on your scrap paper, write your T formula down and put your mathematical signs on the T. Because what this tells us is if we were to have the part and we were to have the total, one top, one bottom, and we were solving for this, what does our math tell us to do? It tells us to divide, okay? So, and if we have both of the bottoms and we're solving for the top, what does our math tell us to do? We just multiply these two by each other. So we're going to take a look at this problem we have here. And it says that broker Bob sold a home for $350,000, charged 7%. Now, we know, here's a percentage, so we know our 7% is going to go over here. I mean, that's a given, isn't it? Pretty easy. And one of the things I always like to encourage the students to do is move your decimal place over 2 places. So when you move this over 2 places, you have to put a 0 out here. So when we convert this to decimal form, it would now be 0.07. See that? Now, broker Bob sold a home for $350,000, charged a 7%. What was the commission he earned or she earned? Well, it's broker Bob, so it's a he in this scenario. But we could have broker Susie as well. And so we're solving for part because we have the total, which is $350,000. And so what does our math tell us to do? It says anytime you have the bottom two and you're solving for the top, you multiply. Now, one of the things that I think is easy for me to understand, it's just easy for me to understand, because we have part, total, rate. I get the rate, but sometimes I get confused on part and total. Well, just remember the part is the smaller number. It's always going to be the smaller number. And the total will always be the bigger number. That's just how I remember it. It works well for me. And you can see in this example, what is the smaller number? Is it the commission that Broker Bob earned, or the sales price of the home? Well, the commission's going to be the smaller number. So I know that I'm solving for part, or the smaller number. And since I have both the bottoms, I just multiply 350,000 times 0.07. And when you do that, or when I do that, I get $24,500. So that's how much Broker Bob earned. So we'll go on to the next problem. Hopefully you're taking notes. I'd encourage you to write these down. Don't forget, I am recording. I'll send everyone a link afterwards so you can go back and rewatch this. By the way, there are some really good videos that we've done. I had a student that asked me the other day, or just yesterday actually, and he said, what should I study? I finished the class, I'm scheduling my exam. Is there anything specific I can be studying? And one of the things, that's why I'm creating this new My Real Estate Exam Coach, because that is really going to be an ideal tool for you to study once you finish the 48-hour course. It's going to be a great tool for you to use to review the material, but it's going to have lots of questions. It has lots of videos, short videos about specific topics. Yes, I'm wearing a coaching uniform, and yes, I have a whistle around my neck as well. But one of the things that I encourage this person to do, who had asked me about the exam, is go back and watch some of those older YouTube videos. There's some short videos. Normally, if someone tells me something about the exam or a question, they can't give me word for word information, but if they give me a topic and say, I couldn't remember what that is, I try to cover that in either a podcast or a YouTube video. Now, all of my podcasts go to my YouTube channel, and they're called audio only. So just go to Global Real Estate School, be sure and subscribe and watch some of those videos. There's especially the more current ones. I mean, they're all very good, but the current ones would have information that people have been saying, I saw this on the exam, and I try to go over that and cover that with you. Okay, good job. So we're going to go to the next question. And it is not too difficult of a question, but you're going to need to know how to do the loan to value ratio, LTV. When you see LTV on the test, this means loan to value. And a lot of times they'll refer to these as an LTV ratio or a loan to value ratio. And what are we talking about there? Remember that most lenders will require 20% or more as collateral for your down payment. If you cannot put 20% down, you have to take out what is called mortgage guarantee insurance, or private mortgage insurance. Mortgage Guarantee Insurance Corporation is one of those vendors out there, but it's called PMI. And so just remember, if you have 80%, that's what they're looking at. So they want 20% or more as a down payment. If you put less than 20%, Then the lender requires what we call this PMI, private mortgage insurance. You need to know that for the test. And what is that? It insures the lender in case you default. It's much harder to foreclose on real estate than it is to go and pick up your car, okay? If you don't make your car payments, they'll send somebody over with a wrecker at your business or your home, or find you somewhere, and they'll pick it up and repossess it, right? It doesn't work that way with a house. In fact, some states like Florida, it takes a long time because they have to go through the court process to be able to foreclose. I was just speaking last week at Marco Island in Florida, and I had my RPR app and I pulled it up on my phone, and there were like a lot of foreclosures in the area. But it didn't surprise me because in Florida you have to go to court in order to foreclose. They use what's called the mortgage state. We talk about mortgage, two parties, a mortgagor, the borrower, and the mortgagee, who's the lender. Well, if the lender needs to foreclose, they have to go to court. What does going to court tell you right off the bat? It could take a long time. Sometimes in some of those states, it could take up to a year or longer because you get a court date and then the attorney has to file something to postpone it. You have to set a new court date. It can be really complicated in that respect. And so foreclosure takes a little bit longer. And in Missouri, in some states where we use a deed of trust, there is that power of sale clause that we talk about. These are all on the tests that I'm telling you. The power of sale clause, which says that the trustee who's working for the bank, who's the beneficiary, they can just exercise that power of sale clause, start the foreclosure proceedings, advertise the sale, and within 21 days, it takes longer than that because of the advertising, but literally within 45 to 60 days, they can foreclose and get the property back. So you need 20% or more down. If you don't have that much down, then the government says to the bank, because banks are regulated by the government, you need to take out insurance. And it's a much bigger deal, the home. So private mortgage insurance just insures the bank in case the borrower defaults. And why are they requiring that for less than 20%? Because it's easier for people to walk away if they don't have a lot of skin in the game. Is that what they say? Okay. If you don't have much holding you to the property, committing you, then, you're probably not going to do as well. It's interesting, a side note, I think it's a good analogy for this. I had a broker, great friend of mine, and he was always paying for students to go to my live real estate school. This was years ago. And none of those students would ever, very rarely, pass the examination. And I used to tell him, please don't pay their way because they're not taking it seriously. They didn't have any skin in the game. Same way with buying a home. If people get a home with no money down, and times get a little tough, they just walk away from it. And then the bank has to go in, paint, clean it up, keep the grass mowed, put the utilities, the insurance, and try to resell that property. So less than 20% have to put private mortgage insurance down. I know this was a long, drawn-out scenario, but you're going to be tested over that. And I want you to understand the rationale, because remember, some of the test questions are application and analysis. So I'm trying to give you the rationale and the reasoning, because if you see a question from that viewpoint, you'll understand why that private mortgage insurance is required. The government requires it because the government doesn't want banks to go out and be making crazy loans, and we end up like we did in 2008. See, they dropped a lot of the regulations for lending, and things got a little crazy, and the housing market collapsed, and a lot of banks went out of business, and it was kind of a tough time. Okay, so with that said, you need to know how to calculate the loan to value on a home loan, okay? So you'll see a question or that will say something like this. Connie purchased a home for $175,000 and her loan was 60% of the sales price. What was her loan on the property? So if Connie purchased a home for $175,000, let's draw our T out. Let's put our math symbols on here. Now, remember total or the bigger number. I'll put big guy. This is part or the little guy right here. And this is percent or the rate. So Connie purchased a home for $175,000 and her loan was 60% of that. So, well, we know where the 60% goes, don't we? Now, remember, John says move that decimal over 2 places. Well, we don't have to put a 0 out there. It's just 0.60. And where does the 175 go? Well, we're solving for what was her loan amount. So would the loan be less than the sales price? Sure it would be. So the bigger number would be 175,000. So what does our math tell us to do? Our math says we need to multiply. So 175,000 times 0.60 gives us $105,000. So don't make these too challenging or too difficult. Just use this T problem. Think in your head, where does the bigger number go or the smaller number go? And then you can solve those in that respect, okay? Good job. Now we're going to do one more of these, which is kind of a, and by the way, you're going to see lots of questions. You know, we have to know how to figure discount points. And a discount point is 1% of the loan amount. Loan amount. You always figure discount points on the loan amount. And so one discount point is equal to 1% of the loan amount. So they're going to try to suck you in to using the sales price. They're going to really word these questions and try to draw you into calculating your discount points on the sales price, but you know that 1% of the loan amount. Now, what is a discount point? Let's talk about that for a moment. A discount point is prepaid interest. It increases the lender's yield on the loan. That's why we have APRs. That's why we have all these truth in lending disclosures. And so you're probably sitting there saying, what in the world do you mean by increasing the lender's yield on the loan? They make a higher profit, okay? Think about it. If I loaned you $100,000, so I loaned you $100,000 and I charged you 5% interest, okay? So I've just given you $100,000. That's what you have in your hand. And I charge 2 points. Remember, a point is 1 point equals 1% of the loan amount. All right? Now, I just gave you $100,000, which is the bigger number, and I'm charging you 2 points, 0.02. Remember, if that was 2%, we move that decimal over 2 places, have to put a 0 there. Our math tells us to multiply. So 100,000 times 0.02 equals $2,000. That's your discount points, because 1 discount points equal to 1% of the loan amount. Now, I gave you $100,000. You have $100,000 in your hand. But at the closing table, what did I just charge you? 2 points. So now you have to count out $2,000 out of your $100,000 I just gave you and give it back to me. So what am I, as the lender, really out of pocket? $98,000. Right? I gave you 100, you gave me back 2,000. So I'm only out of pocket 98,000, but you are paying me back based on a $100,000 loan at 5% interest. But I'm only out of pocket $98,000. So do you see how I just increased my profit as a lender? Or sometimes on the test they use the wording increases the lender's yield on the loan or their profit. The lender just is making more money now because they gave you 100, but they took 2,000 back from you, and so you're still paying me back as though it was a $100,000 loan. But you only really got 98 at the end of the day. So now I'm making more interest off of that loan. And that's why I have to disclose that through the annual percentage rate, if that makes sense. But you need to understand that discount points are always going to be figured on the loan amount. Don't forget that, okay? A discount point is prepaid interest. An origination fee, so I'm going to call this an origination fee. I'm a creative speller, so is also 1% of the loan amount. Okay, same thing that we did here, but the origination fee covers the paperwork to do the loan. All right? So just remember, if you see those on the exam, you always figure it's either, whether it's an origination fee or a discount point, they are always 1 point equals 1% of the, I'm waiting, I'm listening, loan amount. I heard somebody in South Dakota, good job. I think I heard some Missouri and Indiana and Oklahoma folks too, but 1% equals 1 point is 1% of the loan amount. And remember that discount points or prepaid interest increases the lender's profitability on the loan or the lender's yield. They love those words. And an origination fee covers the paperwork. Here's a test question too that's been popping up. Who's the person that looks through all the paperwork and signs off on the loan and approves it before the loan is closed? It is the underwriter. See, you guys are getting, those of you who joined tonight, you guys are getting some great stuff because these are test questions that have been popping up on the exam. So hopefully you're taking good notes. And all right, so I love to use my iPad, but I'm really, I think I love to use the whiteboard or a flip chart, and we've got to get the lighting going a little bit better. My wife and I are really happy that, it's funny, the house we're in right now, we actually bought this home in 2000, moved in 2000, sold it in 2006. I think it was March the 6th, 2006. And we had purchased a pick-your-own blueberry blackberry farm. and we built a new home on our farm, and we did not really want to sell this house at the time, but I had an agent that had some buyers, and she kept asking me if we'd sell it. So we sold the home, and we bought the blueberry blackberry farm. I'm not going to bore you with all the other historical things, except to say my wife and I would walk by this house, or when we would drive by, because we lived not too far from here for a while in our previous home, and when we would walk through the neighborhood, we would look at this house and we would say, why did we sell that home? We love this home. Anyway, long story short, we decided to sell our house last year in December and sold our house, closed it, and our old home was for sale, and we bought it back. And this part of the basement where I'm at, I operate my school and my real estate office out of, which is great. They finished this area, but unfortunately the it's just really tough. So my wife and I were talking, we really want to find an older building in downtown that we can, she does some really cool things with artwork and so forth, and it would be neat if we could have a combination real estate office and have her studio, and then in the back somewhere I could put in a really nice television studio for doing these things and have the lighting up high and all fixed and everything. So hopefully you're able to see everything okay. All right, so we did Connie. We're going to do a couple more of these. Todd wanted to get a loan for $100,000. Okay, so Todd actually got a loan for $100,000. Excuse me. Now, Todd paid $3,000 in discount points, so this is our loan. And Todd paid $3,000 in discount points, it says. And the seller paid $2,000 in discount points for Todd. You know, sometimes the seller can pay some discount points. So the seller paid $2,000 in discount points for Todd. So the question says, how many points were charged? Interesting. Well, these, if Todd paid 3 and the seller paid 2, that's $5,000 in discount points. How many points were charged? Remember our formula? We draw our T out. I always like to put my math symbols on there. This is part, this is total, this is percent. They want to know how many points were charged. We're solving for the rate this time, or the point, the percentage. So remember, bigger number goes where? On bottom, 100,000. And the smaller number goes right here, 5,000. Now, our math tells us this time to divide. See that? And again, I'm just all about simplicity. To make things easy, you always put this number in your the top number in your calculator first, okay? That always goes in your calculator first. So 5,000, press the divide button, put in 100,000, and you will get 0.05 or 5 points. That's how many points were charged. Okay? And if you took 100,000 times 0.05, you'd get 5,000. So you could see a question reworded that way and just, think it through. The classic way they like to ask these problems on the exam they love to do it this way. They love to say, Mary bought a home for $180,000. She put $30,000 down, and she got a 3.5% interest rate for 30 years. The sellers paid this, and they'll give you this, they'll give you that, and it'll go on and on. And down here they're going to say what was Mary's LTV. So, or wait, this could be a problem here, a question. This would just be a T formula, which would be, we're solving for her loan to value ratio, so we're solving for that. She got a $180,000 loan. She put $30,000 down. So I think this isn't what I was wanting to do, but we'll try this. Yeah, so that's about right. So so you would put 30,000 here, and it would give you your rate there. So 30,000 divided by 180 gives me 17%. So she put down 17%, so it was an 83% LTV. That would be 100 minus 17. Now, what I wanted to show you here, and I quickly did that, so if anybody out there has something different, I'm giving a disclaimer that I quickly did that. And what I intended to say is, this is what I want us to work on. They'll give you a question like this, and they'll say she put $30,000 as a down payment, right? And they'll say she paid 4 points. How much were her discount? You know, did she pay in discount? How much did she pay in discount points? Now, see, what we have to remember is this was a sales price, wasn't it? That was a down payment. So we have to take, so she paid 4 discount points, so we know this is going to be 0.04, right? 4%. We move our decimal over 2 places because that's our rate. This is part, this is total, 180,000. But we always figure our discount points on the loan amount, So we have to take 180, subtract 30, and it would be 150,000 would be the loan amount. And so what's our math tell us to do? Multiply. So take 150 times 0.04, and that gives us $6,000. So that's your answer right there. What I wanted you to know, I just want to make sure it looks like we're still broadcasting loud and clear. What I wanted you to know is, or see, is that they will give you the sales price, they'll give you a down payment, or they'll give you a LTV, a loan to value ratio. But you always have to figure your discount points on the loan amount. Same way with origination fees. Okay. Well, good. You're doing a great job. Check the time here. Now, I do want to give a disclaimer that the next 3 weeks, we will probably not be doing live streaming. I will be either recording and sending you the link, or choosing something that I've done previously that has some great problems that are still being seen on the exam. So I'll send those out to you. I may get a little more aggressive in sending some videos out with information over the next couple of weeks, but I'm teaching a course all day on one Thursday, and I'll be here at the house, but I'm going to probably be wiped out, and just some other commitments that I have over the next couple of 3 weeks. So probably over the next 3 weeks, we won't be meeting at 8 o'clock. However, be on the lookout. I will be sending some videos out, either that I've recorded previously or that I'll be doing for you. And I'll actually probably send an email out saying, hey, I'm going to be jumping on and going live this afternoon at 2 o'clock. If you want to join me, you can. Don't panic or get upset if you can't join. I'll always send the recording out right as soon as we finish, as I will do tonight when we finish this as well. Let me take a quick look and just see if there are any questions. If you have a question, please type that in. So I'm just going to go out and take a look real quick here. And I better. So if you have a question, you are welcome to type that in, and I will go out and going out there right now. So I see Robert said hi, and there's Kumar. I think I talked to you yesterday on the phone, didn't I? And Kumar said underwriter. Good. I don't see any other questions right now. Well, great. If just go on and write it out there, and we'll be glad to get to that. And I'm going to make sure I didn't pull my audio out there. Okay, so I've got 8:42. Let's do a couple more here. This is an interesting one. What is the interest rate on a mortgage if the mortgagor makes quarterly interest payments of $1,500 on a $75,000 loan? Now, if you're making $1,500 quarterly payments, we know we have to take that times 4, because whenever we're using our T problems with interest and mortgages, we have to convert everything to annual numbers. So 1,500 times 4 equals $6,000. Now, let's do our T problem. And the $6,000 is going to go where? Well, the loan amount was $75,000, and it wants to know what is the interest rate on the loan. So remember, our rate's down here, so we're solving for this. We automatically know we're going to have to divide, so we just have to figure out, where does the $6,000 go? Where does the $75,000 go? Well, remember, part total. 75,000 is the bigger number, and 6,000 is going to go right here. Our math says divide. John says you always start with the top number. When you take $6,000, divide it by $75,000, you get 8.08, or 8%, because you would move that decimal back over 2 places. So it would be an 8% is what the interest rate on that specific loan. Again, key point here, and the thing you have to watch on these math questions, they will give you semi-annually and quarterly. And if you see those, you've got to convert it, get it to annual, get it to your annual interest, then work your T problem. I guarantee you they will have they'll figure out what 1,500 divided by 75,000 is, and that will be one of the choices. So you got to really read these questions carefully. Make sure you understand what they want you to answer. All right. Now, that might be a little... This is a type of question you definitely need to know how to do, and it's figuring the equity in your home. It's another possible math question. This said if Tom purchased a home for $100,000, so it's a $100,000 sales price, and it's now valued at $125,000. So the value is now $125,000. Tom paid 20% down. So this is what he purchased the home for, and he put 20% down, and he's paid an additional $10,000 off the principal. Okay? So let's do this first T problem. And remember, we have part, total, percent. So he paid $100,000 for this home, and he put 20% down, which would be 0.20. Our math tells us to multiply. 100,000 times 0.20 gives us $20,000, right? Now, when we subtract 20,000, that means Tom got an $80,000 loan. Or we would refer to that as an 80% LTV, loan to value ratio. Now, the question said that he had the value of the home's $125,000, that he had also paid $10,000. I don't have that written up, but he had also paid $10,000 down on the principal. So Tom has basically a $70,000 mortgage balance. But the value is now $125,000. So you just basically take the $125,000 and you subtract the current loan balance, or all of the loans he might have, because they could put that in. And so how much equity does Tom have in his house? And I'm not using my calculator, but it looks like Tom would have $55,000 equity in his house. Now, they will give you some pretty meaty questions with lots of numbers, and you have to go through and pull all of that stuff out and figure out, okay, what is the loan balance today, and what is that home worth today, and the difference between what it's worth and the loan balance is called your equity. Now, they could just have said, Tom bought a home for $100,000. He put 20% down. It's now valued at $125,000. How much equity does he have? In that case, he would have $20,000 equity. See that? Because it would be $100,000 minus $80,000, which is 20. But in this case, he had paid 10 down, and the value of the house actually went up. So just look at what's the value of the house, and if there's no value listed, then it's the loan balance you're working off of, and how much has he or she paid off on the loan, and that's going to tell you how much equity they would have in there. So you do need to figure out, you will have to figure out and understand the principle behind equity in the house. All right, one more, and we'll call it a night because it is 10 till 9. At least I want to go over a couple things before we... So this is just, Mary wants to purchase a home for $200,000. If the bank requires Mary to pay 20% down, how much will Mary finance? Well, this... So again, part, total, percent. Mary wants to purchase a home for $200,000. and the bank is requiring Mary to pay 20%. So I move my decimal over 2 places. How much will Mary finance? So 200,000 times 0.20 gives me $40,000. That's her down payment. How much will the bank finance? 40,000. So Mary's going to finance $160,000. That's her loan amount. All right. So you need to understand loan to values, discount points. I wanted to go over some of that tonight, make sure that you understand. We got to go over the T problem, covered a couple of other side notes. I want to talk to you about a couple of items here before let me just take a quick look. I don't see any other questions there. And so let me come back over here and go to this screen right here. Good. All right. Couple of quick things I want to go over with you before we call tonight a night before we wrap up. You need to understand the difference between a foreclosure and a short sale. Understand that we talked a little bit about that with foreclosures tonight, but a foreclosure is when the bank takes the property back from you. You're not either making your payment, you're not paying taxes or insurance. Remember all of those, when you get into financing, there's all those clauses that are in the deed of trust or the mortgage, and if you violate any of those terms, the bank can foreclose. They can call the note due. Remember, there's a clause called the alienation clause. An alienation clause is when you sell the property without the bank's permission. And you might say, well, how would somebody do that? Well, what if I just said, hey, Robert's on the call. If I just said, hey, Robert, just take over my payments for me and I'll sell you the house. We did like a contract for deed. And so Robert's making the payments to the bank and, he thinks it's his. Well, if the bank found out I did that, there's this clause in there called the alienation clause. They could foreclose on the property. And so you can't do that unless you have the bank's permission. Now, one of the things you might see on the examination is what's called a short sale. What's a short sale? A short sale is when the borrower they're having trouble, they're about ready to lose the house, they're trying to sell it, but unfortunately, the market, their house isn't worth enough to pay off the loan and all their debt. And so sometimes what we've done, and we did this a lot back in 2008 to 2012 and 13, even into 14 a little bit, and today you can see even happen occasionally. Sometimes people go out and they just borrow too much against, take a first, second, and a third or whatever else, and then they're in financial trouble. They don't want to lose the home through foreclosure, so they're trying to sell it. And sometimes they can get the first deed of trust, the first lender, to do what's called a short sale. And that's where the lender agrees to take a lesser amount as a payoff. So let's just say your payoff's $100,000, but I go to the bank for you and I say, look, Mr. and Mrs. Bank, Tom has this house and we've got it listed for $100,000. Everybody's turning their nose up at it. Where we have it listed for high enough to pay you off your mortgage, but it's probably only worth about $80,000. And the bank says, well, he owes us $100,000. And I say, I know, but you're going to probably have to foreclose and put money in the house. And so the bank will sometimes agree to accept a lesser amount so that we can go on, close it, and avoid the foreclosure. And that's called a short sale. So there are tax ramifications with a short sale, but just understand that a short sale is when the borrower's home is not worth enough to pay off all of their existing obligations. Sometimes that borrower may have to pay capital gain taxes on the difference. So if I only sold the house for $80 and Tom owed $100, that $20,000 difference that the bank lost, Tom may have to pay capital gains taxes to the IRS on that $20,000. Plus, the lender could come back and maybe try to get that $20,000 and may be able to get a deficiency judgment. Remember that from the liens chapter? A judgment attaches to all your property, personal and real property, all the debtor's property. So I guess what I want you to understand there are some touchy things about a short sale, but just understand the process is the house isn't worth enough to pay off all the liens. So the lender will sometimes do a short sale and allow the original borrower to sell the home for less money just so they can avoid going through the foreclosure and all of that. So hopefully that made some sense to you. Well, I have 8:57 and I think I did a good job today avoiding the 10-minute rambling session that I occasionally do. But it's always good for me to go over how the course works and some different things. But don't forget, I'll just mention that down below the main course, you have lots of material. Don't forget that I'll be adding some things into the practice exams, and I'm actually going to change the name of that. So you may not see it as practice exams. You may see it as My Real Estate Exam Coach. So don't be startled. And also, remember that I have lots of things I'm going to be changing and adding and doing to this. I just want to get it online so we can start testing it. If you see some typos or an error, let me know. But I'll be working real diligently on it tomorrow, and I hope by tomorrow evening or Saturday or Sunday, I have everything up. So I'm going to pull the practice exams off of there. All of the test questions are still there, plus many more, okay? But they're going to be structured into the categories that the testing service uses. So you'll see property ownership, you'll see transfer of title, financing. There'll be sections, and then I'll have the interactive modules in between all of that. But just understand I'm making some changes and adding that. And it's all really, I'm excited because I think that there's some great information for you to use when you're reviewing and studying. And it's a little different than the main course. Lots of quick videos where I come on and say, now don't forget, just like we talked about discount points tonight. So there's a lot of quick 30-second videos, and I'm gonna structure all those to where you can just watch the videos. They'll be in a section as well. But anyway, keep up the good work. Know that you can always reach out to me anytime you have questions. Be sure and subscribe to the YouTube channel. Watch those. Subscribe to the podcast channel. Study hard. And you're going to do great, okay? So, and again, over the next 3 weeks, I'll be sending you study sessions and may do some of those live, but at different times. Thanks again. Have a great evening, and I will talk to you soon.